Most people believe corporations behave the way they do because of values. They believe companies act responsibly when leaders are ethical and irresponsibly when leaders are greedy. They assume better intentions naturally produce better outcomes. When something goes wrong, they look for bad people at the top and imagine replacing them would fix the problem. That belief feels comforting. It is also deeply misleading. Corporations do not respond to morals. They respond to incentives. What gets rewarded gets repeated. What gets punished disappears. Everything else becomes decoration. This is the real engine behind corporate behavior, and once you see it, corporate actions stop being confusing and start becoming predictable. If you want clear explanations of systems designed to benefit insiders while the public absorbs the cost, subscribe to Insider Expos. This channel exists to explain what corporate language is designed to hide. Inside every large company, behavior is shaped long before ethics enter the room. People are evaluated constantly. Performance reviews, bonus formulas, promotion criteria, and job security all revolve around numbers. Employees quickly learn what actions lead to advancement and which actions stall careers. Those lessons spread. Executives are not paid to build resilient companies. They are paid to hit targets. These targets are usually short-term, numerical, and financial. Stock price, earnings per share, revenue growth, cost reduction, margin expansion. When these numbers rise, executives win. When they fall, executives lose. Everything else becomes secondary. This structure creates predictable outcomes. Decisions that boost short-term metrics are rewarded immediately. Decisions that protect the company years from now are rarely visible. Over time, behavior shifts toward whatever moves the numbers fastest. This is why corporate decisions often appear disconnected from common sense. From the inside, they are logical responses to incentives. Executive compensation sits at the center of this system. Most senior executives earn the majority of their income through bonuses and stock-based awards. Their personal wealth rises and falls with the stock price, not with worker well-being, customer satisfaction, or long-term stability. This changes how risk is perceived. If a risky strategy succeeds, executives receive higher compensation and prestige. If it fails later, the costs are absorbed by workers, shareholders, or the public. The downside is delayed and distributed. The upside is immediate and personal. That imbalance encourages aggressive behavior. Cost-cutting becomes attractive even when it weakens operations. Layoffs become acceptable even during profitable years. Maintenance is deferred. Training budgets shrink. Resilience erodes quietly. From a human perspective, this feels cruel. From an incentive perspective, it is rational. Incentives also explain why wages stagnate while executive pay grows. Worker compensation is treated as a cost to be minimized. Executive compensation is treated as an investment in performance. Cutting labor costs improves margins. Higher margins improve earnings. Higher earnings support stock prices. The system rewards squeezing labor. Managers who reduce headcount are praised for discipline. Managers who protect jobs are questioned about efficiency. Loyalty is rarely measured. Stability is rarely rewarded. Over time, the culture adapts. Corporate culture statements speak about teamwork, integrity, and responsibility. Compensation systems speak about performance metrics. When these two conflict, metrics win every time. This is why corporations can promote ethical values publicly while making decisions that harm workers privately. The incentive structure is louder than the mission statement. Incentives also shape how corporations treat customers. When growth targets are aggressive, sales practices become aggressive. Fees rise, complexity increases, transparency declines. Confusing pricing structures become normal. Customers become revenue streams first and people second. Complaints rise, but profits rise faster. Behavior continues. Public frustration without financial consequence changes nothing. Regulatory fines often fail for the same reason. When penalties are smaller than profits, fines become a cost of doing business. Paying them is easier than changing behavior. The incentive remains intact. This is why the same violations repeat. It is not ignorance, it is calculation. Incentives also explain corporate obsession with stock buybacks. Buybacks reduce the number of shares outstanding. Fewer shares raise earnings per share. Higher earnings per share support higher stock prices. Higher stock prices increase executive compensation. Buybacks require no innovation. They require no long-term planning. They produce fast results. This is why companies often choose buybacks over investment. Building capacity takes time and risk. Buying shares improves metrics immediately. Markets reward immediacy. Workers do not benefit from buybacks. Wages do not rise. Job security does not improve. Long-term competitiveness does not strengthen. What improves is the stock chart. This creates fragile companies. Cash that could have built resilience is spent inflating prices. Balance sheets weaken quietly. When economic conditions tighten, companies that appeared strong reveal hidden vulnerability. At that moment, the incentive structure shifts again. When companies face collapse, executives emphasize their importance to the economy. They highlight jobs, pensions, credit markets, and stability. They argue failure would harm everyone. They ask for protection. Losses are socialized. Gains were already captured. This pattern repeats because incentives never changed. Incentives also shape how corporations seek power. Corporations do not seek power because they are evil. They seek power because power reduces uncertainty. Power limits competition. Power weakens accountability. Power turns volatile markets into controlled environments. Reduced uncertainty increases valuation. Higher valuation increases executive wealth. The incentive is obvious. Market power allows companies to set prices rather than compete on them. Suppliers accept lower margins because alternatives disappear. Workers accept weaker conditions because options shrink. Customers accept higher prices because switching becomes costly. None of this requires malicious intent. It requires scale. Once power is achieved, the incentive shifts from growth to defense. Innovation becomes risky. Disruption threatens existing profit streams. Stability becomes the priority. This is why dominant firms often resist change even when change is beneficial. Adaptation threatens advantage. Tax incentives reinforce this behavior. When tax systems reward debt, companies borrow aggressively. Interest deductions reduce taxable income. Leverage boosts short-term returns. Executives benefit from improved metrics while financial risk increases. Fragility builds quietly. When loopholes exist, exploiting them becomes a competitive necessity. Companies that avoid aggressive tax strategies place themselves at a disadvantage. Boards question underperformance. Shareholders demand optimization. Accounting becomes strategy. Complexity becomes protection. When capital gains are favored, executives prioritize stock price appreciation over wage growth. Raising wages increases costs permanently. Raising stock prices increases wealth temporarily and personally. The incentive points upward, not outward. None of this requires corruption. It requires response. Corporations respond to the system as it exists, not as it is advertised. Public narratives emphasize responsibility and sustainability. Incentives emphasize margins and returns. Incentives win. Environmental outcomes follow the same logic. If pollution carries no immediate cost, pollution increases. If damage can be externalized, it will be. Cleanup obligations that arrive years later do not affect current bonuses. Environmental harm becomes a deferred problem. Sustainability becomes a marketing function rather than an operational one. Reports are written. Language improves. Core processes remain unchanged. Green messaging grows faster than green investment because messaging is cheap and investment is risky. Many people wonder why corporate reforms fail repeatedly. The answer is simple. Reforms that do not alter incentives are absorbed by the system and neutralized. Policies are reinterpreted. Targets are adjusted. Exceptions multiply. Enforcement weakens. The reform survives on paper. Its effect disappears in reality. New leadership often enters with promises of change. Early optimism appears. Then the system responds. Boards ask about numbers. Investors ask about returns. Analysts ask about performance. The system teaches quickly. Intentions matter less than outcomes. Careers depend on metrics, not ethics. Resistance becomes dangerous. Intentions bend under pressure. This is why focusing on individuals misses the point. Systems shape behavior more powerfully than character. Even principled people adapt when survival and success depend on it. When certain actions are required for advancement, those actions become standard. When promotion depends on compliance, compliance becomes professionalism. Over time, behavior stops feeling wrong. Good people adapt. Bad outcomes persist. Once incentives are understood, corporate behavior stops being mysterious. Wage suppression during expansion is logical. Investment avoidance during uncertainty is rational. Buybacks replacing growth is efficient under the rules. Risk-taking without accountability follows naturally. Upside is rewarded immediately. Downside is delayed and distributed. Apologies appear after harm occurs because apologies are cheap. Structural change costs power. The system produces exactly what it rewards. No speech can override that. This does not mean corporations are unstoppable. It means meaningful change requires discomfort at the top. Compensation structures must reward long-term durability. Regulation must enforce real consequences. Metrics must punish fragility rather than reward it. Without those shifts, the cycle repeats. Each crisis feels unique. Each recovery restores the same incentives. Each cycle transfers more value upward. Corporations will follow incentives wherever they lead. Not because they lack empathy, but because the system defines success that way. And as long as incentives reward short-term financial appearance over long-term human outcomes, corporate behavior will continue to look exactly like it does today: predictable, profitable, and quietly destructive.